lately in the past 5 or 10 years, when I talk about risk and I talk at different forums on our radio program, podcast, risk means fear to a lot of people. Welcome to Make Your Money Matter. I'm your host, Brad Barrett. For this week, I want to talk about something that I've been having a lot of conversation with clients on, and really conversations around, is now the right time to invest? This question comes up in good times, in bad times, and we'll talk about what those mean, but is now a good time to invest? Before we get started on that, smash that subscribe button and hit the notification bell so you don't miss a single episode. Let's go. All right, when the market is up, things are going well, people are happy, sentiment is all around good. That's one thing. And truth is, we've seen a lot of that over the past 14 years. Yes, we've had our volatility, but if you look back, and I've mentioned this on previous episodes, starting with the recession in 2008, we've had volatility leading into 2013 with really 2 government shutdowns, Brexit in 2015. So we've seen our shares of ups and downs, and more recently, just 2 years ago, in the pandemic. But in that entire time period, if you look at it, we've also been up on the S&P 500 of roughly 300%. So if you think about that, it's a pretty long bull run. And when things are bad on the other side, and really quickly to give context to this word bad here, when things are volatile or variable, things are showing negative turns like what we've been seeing, we've seen huge correctable downside on overall global markets recently across the board. So let me go out on a limb here before we get started on the topic of is now the right time to invest. There's 2 answers I want to give to that. Yes and no. I know, shocking, big news here, right? But the reason why I want to go through it is the answer is yes or no, depending on where you are in your investing world. And we're going to talk about that. But in general terms, in my opinion, right now, yes, stocks might be quote unquote on sale. And for some investors out there, and for some of you listening, watching, now might be an ideal time to ramp up your portfolios or keep your dollar cost averaging going. But for others, it might not be that time. So what are the time periods and what are the differences between if you should be investing now or continuing investing versus not? So first I want to talk about the subject matter of no. And what I mean by that is now might not be the right time to invest if you have 2 components that I think are really important to discuss here. One is short-term investment time horizon or short-term time horizon, and the other is risk factor. So we're going to talk about both. The first one I want to bring up when it comes to time period is, let's describe what I mean by short-term. In my world, anything short-term is really less than 2 years. And here's my reasoning. One thing when you talk about cash flow planning is you talk about a notion of bucket planning. You have a short-term bucket, a mid-term bucket, and a long-term bucket. Let's talk about the long-term bucket for a second, because that one's the easiest one. That typically is your retirement savings. For anyone out there who has a 401k plan, an IRA, a Roth IRA, that's typically your third bucket for long-term planning. That's your traditional deferred or Roth-like features for retirement or later years, let's say. The short-term and mid-term, I think a lot of people get really mixed up on. First and foremost, I think it's important to discuss cash reserves. Before talking about investing, you have to understand what your cash reserves are. Now, the Certified Financial Planning Board has a rule of thumb, if you will, of 3 to 6 months of overhead. So as an example, if your overhead, and by the way, overhead is your mortgage, your rent, insurances, liabilities, food, anything that basically gets you up in the morning to live. If that overhead, as an example, is $10,000 a month, you should have, rule of thumb, somewhere between $30,000 to $60,000 sitting in cash. But Brad, what about inflation? Usually because that is kind of earmarked for rainy day funds, if you will, it's okay to be sitting in cash by standards, simply because inflation won't hit that hard in the nearest terms. It's the numbers when you go out 2, 3, 5 years, 10 years, 15 years, and you're sitting in cash, that is when inflation will really hurt you. And by the way, the difference between once you have that reserve, so anyone listening right now and you're looking at cash reserves of an overhead, you want to have a good dry powder, if you will, kind of ready for you there. Anything above that really should be looked at for investing, and that's where your time horizon starts. I mentioned this as an example. I had a client I was speaking to recently who recently sold a house and came into some money, some equity, but the goal was to relocate in somewhere between 12 and 18 months. So my question went basically like this to them as a discovery conversation around what's the goal with your money to buy another property and what's the time period? And they mentioned 12 to 18 months. In my world, from an advisor's perspective, just something for food for thought, that's a little short term. Essentially, not sure the juice is worth the squeeze in terms of investing. So yes, you can push out cash reserves past 3 or 6 months, depending on what I'll call goal-oriented planning. Specifically, they had a goal to purchase another house with this money somewhere in the time period of 12 to 18 months. That to me is less than 2 years, the juice may not be worth the squeeze when it comes to investing those dollars. Volatility is still going to be around for a little while. We are seeing, obviously, inflation numbers hit us. We are all seeing a federal funds rate increasing and the overall Fed increasing the interest rates across the board just a couple weeks ago with the Fed rate going up 50 basis points. So we're going to be seeing a lot of this stuff and the market's going to be reacting to it. So I'm not sure the volatility in the short term is worth the investing. But for those out there who have a short time horizon like that, may not be the right time, depending on your own risk tolerance, which is our second category when it comes to the no. When it comes to your risk factor, your risk tolerance, you have to understand when you're looking at investing, any sort of investing, right, is understanding your own risk tolerance. Something we go through here at our firm with Discovery is really understanding your understanding of your money. And what I mean by that is the show is called Make Your Money Matter for a reason. Money matters to people in individual ways. Not everyone across the board is the same. And I talk about this from a behavioral financial DNA. And there's really two forms of it. There's the DNA that we're given, the God-given DNA that I've spoken about a lot. That's no different than the color of our eyes, all the way up to circumstantial, what we live through, good or bad. So when we bring that into a conversation, we also want to focus those two aspects with also what we call needs-based planning. So when we focus on what you need to have over the course of a financial life, we can then focus on what we know we need to return for you in the midterm and long term from your investments. That gives us an ability to have a conversation around risk tolerance. I have a lot of clients saying, Brad, I filled out some 10-question questionnaire years ago that said I was aggressive, but you know what? I turn over at night all the time thinking about my stocks being just too risky. And I say, well, right there, that's telling you something. And to me, it's usually around a lack of education. As I said in previous episodes, understanding money and sitting with an advisor who's experienced, who's an educator, who can really talk with you, not at you, partner with you with your money, matters a lot when it comes to the longevity of investing. Anyone can go set up a brokerage account. I mean, my 6-year-old son can go set up a brokerage account right now and start investing, but that's not the point of it. Yes, we have technology at our fingertips. It's also the matter of sticking with it, understanding that the plan that you have in place is actually tried and true for what your goals and objectives are. And it all comes back to those two things. Now might not be the best time to invest. If you have a short time horizon and your risk factor, you're like that client I spoke to that was just turning over in his sleep, with the risk being too high for them. I mentioned on a couple episodes before that risk means different things to different people. And, if you look at just the last 30 or 40 years, at that time period, risk meant opportunity. We were hitting the 70s and 80s. We had deregulation, Reaganomics was happening. We had a lot of opening of our economy, everything from past the oil embargo and the opening of all that kind of stuff going on. We had a lot of great things. Technology transpired, commerce transpired, the telecommunications industry, all transpired within that time period. And we've seen all that. We've all, watching here, been the benefactors of that growth period. Lately, in the past 5 or 10 years, when I talk about risk, and I talk at different forums, on our radio program, podcasts, risk means fear to a lot of people now. And we all know the acronym for fear, right? Forget everything and run. And that's what I see a lot of times with clients and investing. And I think one of the reasons why I like doing this show, and we talk heavily on our radio programs, on our podcasts, and with our clients here, is fear starts with a lack of understanding and a lack of knowledge. If you take something that you're scared of and you actually spend the time to understand it, it's amazing what can come from it. And that's true of anything social in our world, economic in our world, political in our world, and yes, investing. When someone says they don't like the market or they're scared of the market, it usually has to do with they truly, if they're being honest, don't understand the market. A good advisor should not only be an experienced and credentialed fiduciary advisor to them, but also be a really great educator. Find that person to help make sure if your risk factor is holding you back from a time period of investing. So let's talk about the reasons why it might be a good time to invest, because this question comes up. everything from the good times, as I mentioned, around, hey, when things are good, it's hilarious, right? When things are good, oh, it's too high, it's got to come down, then I'll buy in. And then when it's really bad, oh, it's too volatile, I'm not going to invest, I'm going to wait for it to correct. And it's funny because those are competing arguments. And I hear it from so many investors out there in the world, all of our clients, and I like sharing it because if we really uncover that for a second and truly understand it, it's really more of a lack of planning, to be fair, and a lack of discernment in regards to their discipline of what their approach is for investing. So now might be a good time to invest. And by now, I mean middle part of 2022 here, understanding what we're seeing in the markets. If, to couple on a few things we just mentioned, if our emergency fund, we have enough cash set aside, we don't have any high interest rate or credit cards to pay off or debt obligations, not including mortgage, because mortgage is for an asset, lower in the interest rate, deductible typically depending on your taxes. So those are the three components that I think fall into the camp of good debt. And then you also have a long-term time horizon. If those three things check off in your box, you might want to look at investing. You're like, well, Brad, but it's so volatile. That's when you want to employ dollar cost averaging. I think it's important to uncover what dollar cost averaging really means. Dollar cost averaging at its bare bones is, the point of it is to average out the prices at which you buy into the market. So again, if you are consistently contributing to maybe a retirement plan or hopefully contributing to investment accounts of, you think about just the last 10 years, right? You've been buying, technically, if you look at it, at higher and higher prices, but if you stop contributing now, that means you really get nowhere. The opportunity to buy at lower prices right now is really where it's at. That's the ability to smooth out your investing and ultimately bringing the average cost of the investing down, leaving you with more returns to keep in your pocket. And the reason why I think markets, and there's a lot of reasons here to be fair, but what I want to share on the show today is the reason why markets are acting volatile is obviously everything we stemmed from last summer with regards to inflation coming into the end of this last year, supply chain issues, the Fed increasing our interest rates across the board. So the market's absorbing a lot of what's going on. But the word recession has come around a couple times, and I think it's really important when you look at the word recession, and it's interesting to note on something. Profit growth, if you look across the board, especially in the S&P 500, profit growth remains strong. And it's important to note here, there has never been a recession when corporate profit growth is positive. It's interesting to note. Now, the word recession is an interesting one right now, and I think a lot of people talk about it. It's kind of that next fear item, especially when the inversion of the yield happens on long-term and short-term rates. The reality is right now we're actually seeing a steepening of the yield. And the bottom line, I think, is that recessions typically happen when the Fed tightens too quickly or too much. And I think that's why the conversation is coming around right now. But with inflation well above current interest rates levels, the yield curve positively sloping, not inverted, and really the money supply still expanding, not so sure we see a Fed that is tight, more a Fed that is moderately less loose, if you will. So just something to consider as you're looking about investing. And I want to show a slide here that I'm going to go through around my comment about profit growth remaining strong. As of April 22nd, so about a month ago, for Q1 of 2022, with 20% of the S&P 500 companies reporting actual results, 79% of S&P 500 companies have reported a positive EPS, earnings per share, surprise, and 69% of S&P 500 companies have reported a positive revenue surprise. So for Q1 2022, the balanced earnings growth rate for the S&P 500 is roughly at 6.6%. And valuations, I should add, are returning to long-term averages as the current forward 12-month price to earnings ratio, something we look at here for the S&P 500, is 18.6. It's a pretty good band marker when you look at the price to earnings multiple. So profit growth still remains pretty strong, as you can see from that graph. And I think it's important to note through our discussion points here around what we're seeing in the markets, we're gonna have headwinds. Nothing is just hunky-dory and just gonna go up and up and up. When I say the statement of profit growth remains strong, doesn't mean we're gonna be out without our headwinds. We have inflation, we have supply chain issues. We are still seeing our economy and the world economy, rather, opening up from the pandemic. But staying true and disciplined to your investments matters. I know it's boring. I know it's not the sexiest thing to talk about, well aware, but it works and it matters. And Veronica, my wife, pretty much assumes this is gonna be on my gravestone because I say it so much, but it's time in the market that matters, not timing the market. So if you're asking yourself right now, the question we're talking about today, is now the right time to invest? I would ask you a question. Did you ask that same thing in 2019 when markets were really high, or proverbially high as people consider it? And the market will always hit all-time highs. We hope it hits all-time highs. If we don't have a market problem, we have an America problem. We have a growth problem because it's reflective of our economy. So we should be hitting all-time highs all the time. I got into this business nearly 20 years ago. The Dow was at 13,000. We're sitting here today roughly 32, 33, coming off highs at 36 from the index, if you will, of the Dow Jones Industrial. So it's really important to look at this, that we're gonna see growth. That doesn't mean you shouldn't invest in good times, and also doesn't mean you shouldn't invest in quote unquote bad times. Bad times just mean volatility. It means a correctionable environment. Economically speaking, that's basically letting supply and demand get back in check. It's not, erosion of everything in the world. It's not, the doom and gloom scenario. And I think we still have a hangover a little bit from 2008. A lot of us do. And I think that's normal and a good thing to have in our investing. But we need to make sure that we keep disciplined to the plan, because that keeps the noise out. So it may not be a good time to invest if you have a short time period and or you're not comfortable with the risk associated with volatility or variability. It might be a great time to look at investing or continue with your investing if you have a longer time period of money, you have cash reserves in the bank, you don't have high interest debt being paid off, and you have a long-term time horizon, as I mentioned. So depending on where you fall in that camp, answering the question is really a two-part question. It really depends on where you're at in your planning and really where you're at in your overall investing environment and your investing goals and objectives. So I want to put up a graph that we actually spoke about a few weeks ago. It's called Bumps in the Road. And our investment committee here at One Capital Management put this together. And it's a good reminder that the start of 2022 reminds us that markets don't always go straight up. And I think when we're talking about a question of, is now the right time to invest, for those that see the value of investing on a disciplined basis, understanding that there will be bumps in the road. This year right now, we obviously have supply chain issues, inflation issues, but you look at the time periods here on this graph, you can see there's other issues at bay. 2013, we had government shutdowns. Obviously, you go back to 2008, recession, 2001, tech bubble. So you can see the intra-year declines. If you look at that number, of the past 42 years on the S&P 500, 33 years were positive. And if you invested 42 years ago in the S&P 500 and lost your password, just fell asleep, you would have had a 6.5% annualized rate of return. This is probably not new to most people watching. You can Google this and you can look it up. You can pull historical data. What is interesting, I want to bring this to everyone's attention, is that over that same time period, the average intra-year decline was negative 14% on the S&P 500. And what does that mean? Look at 2020 as an example. We see that negative 34%. We know that happened in March to April of 2020. Throughout the entire 12 months of 2020, we ended the year up 16%. Take last year as an example. At one point last year, we were negative 5% on the S&P 500. We ended the year up 27%. Markets don't always go straight up. So it's important to know when you're looking at the question of, is the right time to invest, you can see that good times or bad, we don't want to be that investor that lets our emotions get involved. We will be the same person asking when things are really good. We'll be saying, oh, you know what? It's too high. Market's too high. I'm gonna wait for it to come back down. Is the same person that'll be having the questions of when things are volatile or variable in the markets. Oh, I'll wait till things settle out, then I'll get invested. Problem is that'll never happen. It'll just sit on the sidelines. And people always ask me, okay, when things are volatile, should we cash out or should we move to cash? The reality is it's a two-part question, right? You have to be smart twice. You have to know when to get out and know when to get back in. And so it's not, again, timing the market, it's time in the market. Okay, it's time to answer your questions. If you have a question or topic you'd like me to address, you can leave a comment or question in the comment section. Or if it's something you want a bit more personal approach to it or more of a one-on-one, you can just go to our About page on this channel and send us an email. We'll always keep the questions we read here, I read here anonymous, so you never have to worry about or your name being shared or anything like that, but we'd love to hear from you. And the question that came today around, actually had a perfect timing on this subject matter, is pessimism and the discussion of consumer sentiment. We hear these statements out there, that, well, looks like the market as a whole, people are just fearful right now. And we talked about fear. And I want to put up a graph here. It's interesting because our investment committee put this together and we actually titled it, Pessimism is Good. And I want to answer this question this way. This slide shows the University of Michigan's index of consumer sentiment stretching back over the last 50 years with 8 distinct peaks and troughs noted. We also want to show, and I want to show in this graph, how much US stocks went up or down in the 12 months following the peaks or troughs. So on average, if you look at this, buying at a confidence peak yielded a return of 4.4%, while buying at a trough returned 24.5%. Now, in addition to this, the Ned Davis Research Crowd Sentiment Poll has reached a level of extreme pessimism about the markets. This is not to argue that US stocks will return anything like a 24.5% return in this year, or that the road ahead is smooth. Many other factors will actually determine that outcome, but most often, is what I'm trying to share here, is when pessimism is high, subsequent equity market returns are also high. So when you talk about consumer sentiment, pessimism, and really understanding what that means in the market, it's interesting to note, and this University of Michigan Index consumer study was really interesting if you look at it. You have more of, if you think about it just logically, you have more of a growth to go if you're buying at a discount or buying at a price that's lower than you will later. The one thing we know about investing, right, is buy low, sell high. So if we can find those areas, and you're never gonna be able to time that accurately all the time. So keeping to a disciplined approach, dollar cost averaging, and just staying the course, having your objective in mind for what you're trying to do with your money. What's your why you are doing what you are doing with your money will make your money matter more than anything else will. And again, if you have a question or a comment you'd like me to read here, leave it in the comment section or email us in the About page on our channel. And before we go today, if you found anything helpful and want to learn more, you can visit us at onecapital.com, or you can scan the QR code on the screen with your smartphone and it'll get you right there. You can also call or text us. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value relationships. It's the lifeblood of what we do. So click, call, or text us today. If you're not following us on social media, you should be. We're sharing great information on all of our social media platforms. You can follow us at Make Your Money Matter. And as I often say, if you enjoyed the show, share with something you like. If you don't like the show, I guess share with something you don't like. But until next time, always remember, make your money matter.